In this video, we're going to concentrate on one single aspect of financial planning, and that has to do with what's referred to as pro forma analysis. So let's kind of get started and jump right into the game here. So what we want to do is we ultimately want to forecast what we think will happen to the company over the next several years. How do we use this process? Well, if you project income statements, that allows you to project um, balance sheets. It allows you to predict financing needs for the company, which ultimately leads to the free cash flow of the company. And of course, if we are going to project balance sheets, etc., that gives us the ability to predict financial policy assumptions. And of course, those changes may have some impact on the weighted average cost of capital. So this can give us flow, if you will, of how we can predict future cash flows, future values of the company. In addition to some other purposes, as helping with strategic planning, understanding what changes will incur when certain changes are made, such as if we think that our customers are taking too long to pay, we want to get them to pay quicker. If we take steps to do that, where's the implication, right? If we put some stricter guidelines, we may lose some sales. If we give them discounts, although it may reduce the actual profit, it could increase our ability to use cash quicker, which ultimately could increase profits of the company as a whole. So there's lots of uses of what we refer to here as pro forma analysis. So the basic idea is we want to predict cash and other funding needs. How do we do that? The first thing we do is predict sales. We need to understand, what do we think will happen to sales next year? The second thing we need to understand is how will a change in sales affect the needs for assets? Certainly, if sales increase, we may need increases in inventory. We'll probably see increases in accounts receivable. Most of our inventory is bought on credit, so it should affect accounts payable. So all of those line items are impacted by sales. Now, that doesn't mean that if sales go up, we're going to have to buy more plant and equipment. We may, but that depends on our current sales capacity now. So again, the idea here is we need to predict sales so that we can predict the asset base. Once we understand how much assets we need to look and see how much money we have. So the process in the end, find out if you have to buy plants and equipment. If you have to buy plant and equipment, where's the money going to come from? There's only three places the money can come from. It can either come from long-term creditors, common shareholders, or retained earnings. So those are the only three places that we can get this from. And we will have techniques to look at exactly where we're going to have to go to get that money. So again, we need to start with a projection of sales growth, right? Again, as I said, we need to understand the relationship between line items on the income statement and sales. The next thing we'll need to do is to try to see how these line items interact when we put them in a financial statement. So the output from this process, again, in the end, let's try to identify whether we have a cash shortage. That is, do we need to go out and get more money, or do we have some kind of a surplus? We have to figure out what to do with those excesses and, of course, where to find any of the shortages. So let's look at the spreadsheet and how this actual works. So we need to have financial statements of a company, obviously, and we're going to input that, the last income statement and the last balance sheet of the company, we're going to input that into a worksheet. Now, this is a template, so you may have to finesse some of the numbers a little bit to make them fit in the template. Certain kinds of companies are a little bit different than others. Of course, you can always create your own financial statements, and of course, that certainly there's nothing wrong with that. And in this case, in my worksheets, all of the yellow boxes are data boxes. The other things are typically password protected, and they're formulas. So in this case, for sales, we just need to know sales. You need to gross profit. It'll calculate the cost of goods sold. Likewise, if you know EBIT, it calculates the other operating expenses, etc. So you can see we just input the most recent income statement. Here's the statement of retained earnings. Here's the balance sheet. And of course, it does some calculations for us. You can see that the accounting equation holds. You can also see what our current capital structure looks like. 68% of the long-term financing comes from long-term debt, while 31%, almost 32%, comes from common equity. Now, what is common equity? In general, common equity is common stock plus retained earnings. When we start this analysis, we're going to assume that profits of the company, after we've paid dividends, the profits that are left over, those all go to retained earnings. So here you can see our statement of retained earnings. We paid out $353 of dividends, but net income was $1,400. So there's roughly close to, let's say, just a little bit over $1,000 that increased retained earnings. So the retained earnings here already reflects the investment of retained earnings for this year. So likewise, next year, when we predict the next year, retained earnings, the internally generated capital of the company, are assumed to already have been invested. So in the end, if we need to gather money, we're looking at getting money from issuing sometimes a long-term debt or issuing common stocks, because retained earnings, internal profit, has already been reinvested. So the next thing we need to have is some data. And of course, if you wanted to make this a little bit more complicated, add more line items, certainly you could do that. So we basically did some analysis on this company, and this is the data that we found. That sales has been growing around 3%. We think it'll continue. Cost of goods sold are around 59%. And working down, these are all we can assume to be averages of historical information. Now, of course, any change that we would make or suspect, we can incorporate in here, right? So if we know that the average cost of goods sold is 59%, and something has happened in our production line, for instance, that's made us a lot more efficient, maybe we want to change that number. We'll say, maybe it's probably closer, maybe 54% now, because we're going to save all those expenses. So again, the yellow boxes, what you think is going to happen in the future, mostly we're going to base it on historical information and then adjust it for new things that we as managers think are going to happen in the company. We also do the same thing for the balance sheet. Here are some balance sheet items, right? Here's our current assets. We have a current ratio. We expect it to be 0.7, right? And if you look here, here's what we see first. When you go down to the bottom here, right? with this calculation on the spreadsheet, it says, look, you currently have $4,600 in assets, but given the changes, given these ratios on the balance sheet, you actually need $62,000. So our answer here says purchase assets, yes or no. It says you need to purchase assets. So you have to decide how much assets to buy. So we say, well, look, if we're going to build a new building, that building is probably going to cost 75 grand. We only needed 62, but we know we need 75,000. So when you plug in a number here of 75,000, this box turns to no, because now on the spreadsheet that we're going to create, the balance sheet, it increases it by $75,000. In addition, right, what if it said that you could sell some assets, right? So maybe we have too much assets. We could find maybe some obsolete things that we don't use anymore, don't need. Maybe we could sell some fixed assets. But regardless, you just need to know that once you include these variables, again, they all come from some kind of a historical analysis, updated and upgraded into some type of a prediction of where you think they're going to go. So okay, so now what happens? We put in the data of things we think are going to happen, and here's our first income statement and retained earnings statement. So here's the previous year. Here's what we think will happen next year. If you notice here, there's a 3% increase in sales. When you plug in all that other data up there in formulas, it turns out our net income is going to go from 1414 to 3514. Now, one of the things just to keep in mind for a second or two here is that interest doesn't change. The reason interest doesn't change is because we haven't decided what to do with financing yet. Just hold on just for a second and we'll come and we'll see how that changes. Net income, again, went to 3514. Based on our payout of dividends, we're going to pay out $879. So retained earnings changes now to $87.81. So essentially there was a little bit over a $2,600 increase in earnings that were reinvested in the company. Now that's going to show up in the balance sheet. Again, that number, right? That 87.81, it's right here in the balance sheet. See, it increased. So we've already invested all of the profits of the company that we want to invest. Again, all of these numbers come from formulas, from the data, the assumptions that we made up below. Now, here's the important part. If you look at this, it shows that what? We need $101,000 worth of assets, but we only have $31,000 worth of liabilities and equity. So obviously we need money to buy the extra almost $70,000 worth of assets. And that's this balance right here. External funding needed. If it's positive, that means we have to go out and get money. If it's negative, it means we have a surplus. We have to decide what to do with that. So the next step, you just say, okay, here's our current capital structure. What do we want that capital structure to be? We would like it to be 65% bonds, 35% debt. We want this to change. We want to reduce our long-term debt by a little bit over 3.2% and put all of that money into common equity. So we want to change our financing structure. So 65% of the 69,000, 45,000 comes from debt. The other remainder, 24,000, we're going to have to issue some new common stock. Now, what happens when you issue common stock? You have to pay dividends. What happens when you issue more debt? You're going to have to pay interest. So we need to have some idea of the cost structure of interest. So in this case, notes payable, short-term debt, we think it's about 3.5%. The cost of bonds is 4.5%. So the balance sheet is going to change by this. The income statement is going to change by this. So let's look and see what happens when we move up. And this isn't the easiest slide to see here, but this is the income statement and the retained earnings statement. As you can see here, here's that increase in interest. So we have approximations. So what the spreadsheet does is it changes it, finds out what the difference is, changes it, finds it. So in the end, to go from the third to the, we only need one more dollar to figure out where that money is going to come from. So in this case, you can see at the end, we have $1,573 is the net income, $73.25. The ending balance here stayed the same. All we did was jiggle around the dividends. The dividends are going to change because common stock changed. Next, here's the balance sheet. Here's the change in debt. Here's the change in common stock. And again, you can see this year we needed at the second approximation. Again, we still needed 101,000 in assets, and now we figured out where we're going to get 99,000 of it. So then it does it again. 101, 190, 101, 160. So again, we're narrowing down through this iterative process till we end up at the end where these things are basically even, right? So now the balance sheet has essentially balanced itself. Across the bottom, you can see how this happens, that every iteration, more and more of the money has been distributed or assigned, if you will, a certain form of financing. Each form has its own cost. We know what the interest is, and we know what the outflow is from dividends for our shares that we changed. So that's the basic structure, and it's a little complicated. It's not the easiest thing to really follow. But once you have the spreadsheet created, it's a very simple process. And the important part of this are the assumptions, right? So once you create the spreadsheet that works, you really have a very powerful tool to now see what would happen if sales don't go to 3%. What if they actually went down? You can see how that's going to affect your company. What would happen if we decided that we wanted to increase our dividend payout stream? Well, if you increase dividends, that means you decrease retained earnings, which means you're going to increase the amount of common stock and debt that you're going to have to issue. So it's a complicated process that is a very powerful tool for managers. So that's it for this video. I look to see you in the next video.